This is Philip Rich, Chief Investment Officer for Seaside Bank and Trust, and this is one in a series of economic updates from Seaside's Wealth Management Department. For context, this recording is being made on July 16th, 2021. The recovery from the pandemic-induced recession is continuing and indeed is gaining momentum. Total U.S. output measured by GDP is in the process of passing its pre-pandemic peak, and growth should pass that prior peak in the third quarter of 2021. At this time, almost half of the U.S. population is fully vaccinated. Although mutations of the virus remain a concern, and the rate of vaccination in the U.S. is slowing. Supply constraints and logistical bottlenecks are holding the economy back from what would be an even stronger rate of growth. An example is the limited availability of chips holding back auto production. There's been substantial improvement in employment, but we are still millions of jobs short of pre-pandemic levels. There is also evidence of resurgent inflation in the prices paid. There is strong debate amongst analysts as to whether this inflation is transitory or a new cycle of inflation is coming to evidence in the U.S. economy. The service sector is still catching up with manufacturing, but it also has the potential to extend our impressive growth through the remainder of 2022. The service sector in the U.S. is substantially larger than manufacturing, so it has the potential to be a major contributor to continuing growth throughout this year and next. Strong GDP growth continues. Real GDP increased 6.4% in the first quarter of 2021. We'll get the first numbers for the second quarter of 2021 later this month. The drivers of that growth are intact. Households and therefore consumers are flush with cash. There's been aggressive federal aid through this recession and monetary stimulus on top of fiscal stimulus. The services economy is reopening, and we're seeing substantial improvement in areas such as travel, leisure and hospitality, and restaurant traffic. A growth rate above 5%, and perhaps even substantially above 5%, is achievable for 2021, especially if the service sector continues to improve. Total consumer spending now exceeds its pre-pandemic level, led by spending on material goods. Spending on services is presently increasing, but is only now on the verge of a full recovery. Retail sales for June were positive despite concerns that there would be a decline in retail sales. Sporting goods, furniture, and autos did indeed decline, but they were more than offset by electronics, clothing, and restaurants. Some purchases of tangible goods were pulled forward during the recession. However, overall retail sales remain strong as the services sector plays catch-up to sales for goods. Unemployment rose slightly to 5.9% in June after declining to 5.8% in May. However, the increase was due primarily to more people returning to the workforce and actively looking for work. This is actually a positive development in the employment picture. We are still millions of jobs short of pre-pandemic employment levels. Job openings are at a record high, and yet employers are reporting difficulties filling open positions. So it will be some time before employment fully recovers from the shock of this COVID-induced recession. Over half of the jobs lost to the COVID-induced recession have now been recovered. Payrolls grew by 850,000 in June, which is the fastest pace of the last 10 months. However, it will take many more very strong months to fully rebuild the workforce. We are still millions of jobs short of where we were prior to the pandemic-induced recession. Inflation spiked in June, with the all-item CPI index hitting 5.4%. The core CPI hit 4.5%, which is also its highest in 30 years. Much of the increase stems from autos. New cars were up 2%, used cars were up 10%. However, we are seeing evidence of inflation in travel costs, hospitality, food, and housing. Rent is up sharply from prior periods. There is presently considerable debate amongst analysts as to whether all this represents a new and more durable cycle of inflation, or whether in fact this inflation will prove transitory. Those that argue that we are in a new cycle of inflation point to the degree of the increases in prices and the breadth of these increases. They also point to the fact that many businesses are currently planning to increase prices in the future. They point to the fact also that wages have increased, as has the cost of hiring workers. Analysts that argue that this is all transitory point to the fact that many prices in the market today are the product of temporary supply constraints, and that as these supply constraints are abated, prices will return to a more normal rate of inflation. They also point to the fact that the U.S. is presently only operating at about 75% of its capacity, and typically it is difficult for inflation to get a foothold in the economy when the economy is only operating at 75% of its capacity. In the end, only time will tell whether this inflation is permanent or part of a new cycle of inflation, or transitory and rooted in the temporary supply constraints that have been brought on by the COVID recession. The spike in inflation for the time being has not caused a dramatic increase in long-term interest rates. In fact, quite the opposite. The benchmark 10-year Treasury yield is at 1.38%, down from 1.5% 1 month ago. The yield curve is also flattening as short-term rates have moved up as well. Overnight rates had been as low as 0%. They are now in the neighborhood of 5 basis points. So the combination of longer rates coming down and shorter rates moving up has created once again a very flat yield curve. The stock market continues to hit new highs as the economy emerges from the COVID-induced recession. It should be pointed out that at these levels, valuations are really quite stretched. Investors are paying quite a bit for a dollar's worth of earnings at these valuation levels. In order to continue to justify these high valuations, stocks will need ongoing support from improving earnings. However, so far, many industries and many companies are reporting record earnings coming out of this recession. It should also be pointed out that the challenges of this recession have forced many companies to become more innovative and more efficient in order to survive. This is a typical aftermath of a recession. Stocks have also benefited from the fact that fixed income investments are experiencing historically low rates of yield, even though they have come up from the very lowest levels that we saw at the worst of the COVID-induced recession. Thank you for joining us. As a reminder, investment products offered through Seaside Bank and Trust are not insured by the FDIC or any other agency of the U.S. government. They are not guaranteed by Seaside Bank and Trust or any of its affiliates, including United Community Bank. They are subject to investment risk and may lose value. Thank you again for your attention.